What up, Hyperchange? Welcome to another episode. Today we're talking about the oil price collapse yesterday, a historic moment in financial history as the future price of oil went to negative $37 per barrel. This is the first time the price of oil has ever gone negative in the futures market. This is a landmark just moment for financial markets and commodities in general. So I want to break down how this is even possible and how, if the price of oil stays depressed for a long time, that could impact the adoption of electric vehicles and potentially the sale of Teslas. So let's just start by the oil price chart here. You can see oil trading about $60 to start the year, sort of in this downtrend, getting worse and worse as the illness 19 outbreak continued, with things really starting to deteriorate in March, with us going from about $50 a barrel to start the month down to $20 per barrel to end the month. And then throughout April, it was holding around the mid $20 per barrel range, and then absolutely fell off a cliff yesterday, going negative. It's at about $9, I guess, as I'm recording this episode. So how does this happen? What actually went on? So it's very important to remember that what are we looking at? What is the price here? This is the price of a futures contract for oil. So this is very important because you might be like, how does something go below zero? Because you actually have to take physical delivery of oil barrels. I think each contract is like 1,000 barrels of oil. Like, these are big jugs of like toxic chemicals that you literally have to take delivery of. Say you're buying this contract, you're long oil, you have to actually accept the physical delivery of the goods. And so what's been happening, this weird sort of nuance of the markets hasn't really mattered in the long run, because if you didn't actually want the oil, you could always just sell it to someone else right before the contract expired who actually did need the oil, someone in the industry. But now the entire oil industry has been totally rocked by this economic crisis. I mean, economic output has just stalled. I mean, I don't have to tell you why. Illness 19 outbreak, nobody's leaving their homes. This particularly affects the transportation sector of the economy. Nobody's driving to and from work. Airplane travel is falling off a cliff, and these are the huge drivers of oil consumption. And so if nobody's consuming oil, demand is dropping off a cliff, and there is only so much oil they can store. So while demand is falling off of a cliff, there's been a massive continuation of supply. They just keep flooding the market with more and more supply. And oil is very, very interesting and very geopolitically a fascinating commodity, because not only do you have huge companies like Exxon and Chevron who are trying to, make a profit and stay afloat and find their lower production costs, you also have nation states competing here. We're talking about Saudi Arabia, Russia. Their cost to produce oil is way lower than some of these US companies. They say the price in Saudi Arabia to produce oil is just a couple dollars per barrel, so they can still sell it at $10 per barrel and make a profit and get everyone out of the industry before the price rises. So you have all of these crazy dynamics going on in the oil market, but essentially what this has related to up until now has been a massive influx of supply, and people are storing more and more oil because nobody's using it, but the supply keeps coming online. And so eventually this reached a tipping point, and that was yesterday. And because of the weird structure of this future pricing contract, you literally had to take delivery of oil, but because there was nowhere to store it, there's oil everywhere, there's too much of it, everybody has oil and nobody needs it, then all of a sudden this massive asset of getting to take a delivery of 1,000 barrels of oil just turned into a liability because no one else would buy it. And so then you sort of had this downward death spiral of, we have all these contracts, let's get out of them because they're worthless and potentially have negative value. And so at some point, taking delivery of oil, storing oil, this toxic chemical has costs associated with it. And so that's why people are literally paying someone negative dollars with the value of this contract to take oil off their hands. And so so at a high level here, this is really just a symptom of an on-paper trading futures mechanism of why the price went negative. But it also just really, the fact that we hit this breaking point really signals a fascinating inflection in the sort of power dynamics of the oil industry. And you can really see that I think this is a time of reckoning that has been a long time coming, because I think a lot of reasons, electric vehicles, oil goes into a lot of plastics. I just think there's generally been sort of a wake-up call as more economies shift to green energy and renewables, that long-term the structural demand for oil could go down. And now as the economy paused, we're sort of accelerating this massive implosion of the industry. And you think about all of these companies like Exxon and Chevron, and I won't even mention some of these smaller mid-tier who are even more levered oil and gas producers. I mean, these guys are in desperate need of capital. Their entire way their company is structured is they have massive balance sheets, they have reserves, and they price their whole reserves and their balance sheet and how much debt they can take on based on the value of all these oil sitting in the ground that they own. But if the price of oil collapses, the value of those reserves collapses as well. That totally distorts the leverage ratio on the balance sheet. I mean, you can really see how these are very highly levered, in my opinion, house of cards. And bring it back to Grammy, shout out to my grandma. I think she is a perfect microcosm of what has happened with these oil stocks and a lot of old companies in the economy. These retirees owned oil companies in their portfolios for the dividend. Many of these oil companies are dividend aristocrats and have been raising their dividend every single year for decades. This is something that old people just rely on and count on for their income, and they can't sell. But what is happening is, although a dividend has been increasing and ramping, the core earnings and value and intrinsic, cash flow of that asset has not been growing at the same rate. And over time, this has been increasingly levering and stretching out and causing strain on these business models. Just to put things in perspective, in January, this is a note that I read about Exxon Mobil that I actually sent to my dad about Grammy, saying, sorry, Grammy, because I feel bad because I'm like, Grandma, like, don't invest in oil. Oil's not the future. It sucks. And these companies are crappy run companies. So this is the note. It says ExxonMobil shares closed Thursday, lowest since October 2010. The company's malaise runs deeper than the weak state of the crude oil market. CEO Darren Woods is running a counter-cyclical strategy by investing heavily in new oil and gas assets, continuing on a windfall of cash to arrive from the investments in the mid to late 2020s. Keep in mind, this is a CEO talking about how much money they're going to make in 10 years. Well, he's making millions of dollars now, probably going to be retired by then. He doesn't actually really care what's going to happen. But anyway, the point is, Exxon is ramping capital spending above $30 billion per year, and the short-term cost of those investments is that the company cannot fund dividend payouts with cash generated from operations, instead resorting to asset sales and borrowing, according to Edward Jones analyst Jennifer Rollin, making Exxon the clear outlier among big oil companies. They also point here, following Chevron's big asset write-down last month, analysts at JP Morgan thinks Exxon may have to follow suit, which would be a negative for optics. So anyway, at a high level here, this was January. This was pre-illness 19 outbreak. Exxon was basically like, okay, we can't cut our dividend because then our whole, equity is going to collapse. All these people are going to stop buying it. So we'll do anything we possibly can to keep that dividend going up, including selling off assets. Even though we know that our internal cash flow can't even pay this dividend. Like, I think that's ridiculous. And so awful fiscal management from Exxon heading into this crisis. And then what's their strategy right now? With oil at $60 a barrel, let's go all in and invest on these super, much higher tier price assets. That's an awful idea because all of those assets, fast forward 2 months later, are going to be totally underwater because the price of oil is so low, and you are competing with nation states like Saudi Arabia and Russia who, they're agreeing to production cuts. Who knows what that's going to mean? But I mean, these companies or these nation states could survive with oil at 15 to 20 a barrel for years, and they may just do that as demand shrinks, and then we're going to see a massive wave of bankruptcies in the oil and gas sector. This is why literally the next day after this oil price collapse, we've seen Donald Trump get ready to, talk about a bailout or some sort of stimulus package for oil producers because so many of them are about to go bankrupt. And I think that at a high level here is what this moment yesterday represented for the oil market. Yes, oil prices aren't really negative. It was just the futures contract, but the structural long-term demand of oil is looking weaker than ever, and it's looking like the price of oil long-term could be much lower than people were expecting because of this new structural demand and the way the geopolitical situation is working out with Russia and Saudi Arabia, in my opinion, going to be drowning out all other oil producers who just don't have who just can't compete on with a higher cost structure. And so I think this is a fascinating thing to watch. And now, how does this relate into the electric vehicle market? If the price of oil continues to collapse, stays at these levels, the price at your gas pump is going to go way down, could even be below $1 a gallon, unprecedented deflation in the cost to fill up your car. So how does that affect the total cost of ownership of, let's say an electric vehicle versus a non-electric vehicle? So, before this, the gas car was actually way expensive to, refuel or recharge than the electric vehicle. You're plugging in at home, usually like 33% of what you would be paying at the gas pump per unit of, per mile driven, just way more efficient to use it at home. So even if the price of oil collapses, maybe it comes closer onto par. That's a really small amount of the total cost of ownership, maybe 5% at most dramatic change because of this oil price movement. And so I don't think people were buying Tesla because, the price of oil was so high that it was making their gas car look too expensive. I think this is truly a lifestyle industry shift. And although on some level you might say this is going to, okay, it might, it does make it a little bit cheaper to operate gas cars. It could, for a very small amount of people, cause them to not go electric yet. But I think inevitably the inflection point is already passed. The technology of batteries, drivetrain, charging is all getting better and better and better. The internal combustion engine technology is stagnating. And I already think Tesla, in my opinion, has reached that inflection point and is way better than the internal combustion engine. And this small change in gas prices is not going to stop that. And even if it does slow it down a little, that massive tidal wave of improving technology is what will drive drive the adoption of Teslas and electric vehicles, not a slightly cheaper economic situation right now. And so that's my view on how this will affect the automotive market. And then on the flip side, we're seeing all this craziness in oil. I just read a Bloomberg article about how GM and Ford are running into massive problems with their balance sheet and are a house of cards, something I've been saying on the channel forever, because these companies are basically banks. They're loaning, loaning financing operations so that you can buy a car for a super cheap interest rate. They're guaranteed, and what is that loan backed by? That loan is backed by this asset which you have. You have to return the car if you can't make your payments or whatever, right? And so all of the assets and cash flow lines on GM and Ford, I think they probably did a crappy job figuring out who they were going to loan to. The credit ratings aren't great. A lot of those people have gotten laid off. That's going to look really ugly. But at the same time, the asset that's backing all of these loans, the internal combustion engine car, the price of that is crumbling. The trajectory, the model of how these prices last over time for the internal combustion engine is crumbling. Nobody wants these used cars. There's a massive influx of supply. And I see this potentially being, just as much as the oil companies are a house of cards built on, financing, reserves and all of that, things with debt and keeping the dividend going. I think GM and Ford are as well. And so this is really, really fascinating. I just think we're just scratching the surface of seeing all of the economic and financial market fallout from the illness 19 crisis. So anyway, I hope this leaves you with more questions than answers. Crazy moment in financial history. Would love to know what you think about, all of this in the comments below, your theories about geopolitical, oil pricing strategies. Will this affect the electric vehicle adoption? How are GM and Ford doing with their balance sheets? Let me know in the comments. I read them all. I try and reply to a bunch of them. Anyway, huge shout out to our Patreon supporters, producers, fun in the channel. I'll see y'all next time. Peace.